We're going to have a unique conversation now regarding, well, the IRS and how they tax crypto. Our expert is Miles. He's been in the industry for a couple decades, and his company that he's with is TaxBit. They're focused on making sure you have your piece. And globally, around the world, from the United Kingdom to the United States, the most important thing anyone can have is their piece. Let's bring him up now. Miles, welcome to the stage.
Thank you, Dustin. Thanks. Did we lose the clicker? Thank you. All right, good morning, everybody. There we go. We're up. So first, before I get started, I wanted to thank everyone, or thank CCA for inviting me here. I was one of those people that came outside of Europe. I came all the way across the pond from the United States. As Dustin pointed out, my background, I now am head of government for a crypto sort of tax and financial accounting software company. What we're trying to do is smooth over how you report, how you meet your compliance needs, particularly for US taxpayers, but also global taxpayers. And as well, in the United States, you have registration compliance requirements for SEC purposes and whatnot. So our software company does that. My background before that, though, is I spent 15 years, I was a litigation attorney for the Internal Revenue Service the last 4 years or so before I left. I was sort of the point person in the field with digital asset sort of compliance, helping the IRS understand digital, distributed ledger technology, blockchain, how to investigate it, what the tax policy should be for it, and working through it. So that's what I'm here to talk to you about today. I was very excited to come, and then I found out I only had like 20 minutes to talk about US tax policy. Any of you who know anything about the United States tax code is literally the sort of base ground for social engineering in the United States. It's how everything gets done. So I'm going to try and do sort of a survey here, but I'm on a panel a little bit later, sort of a multi-jurisdictional panel, and I'm excited about that because we'll have a chance to talk about different ideas from different countries and how they all come together from a tax policy standpoint. So to get started, basics, like a basic background for US tax policy in general, before we jump into sort of digital assets, is US income tax principles generally run on a couple things. The first one I want to point out is not so much a principle, but it's something that sort of sets the United States apart from many other countries. And it's that the United States operates off a worldwide tax system, meaning if you are a US citizen, you're going to get taxed on your income wherever it's at in the world. This becomes relevant in the digital asset space because, as all of you know, digital asset stuff exists in the cloud. There's sort of this jurisdictional problem that stumbles all over the world that you can't figure out who's in charge of what or what country gets to oversee what. That makes the digital asset problem a little bit easier in the United States because if you're a US citizen, you're going to get taxed on your income or your gain from the sale of property regardless of where it occurs, even if it occurred in cyberspace. So that's an important foundational point. The next part, though, is that US tax policy generally runs on economic-based tax policy. And what this means is they always look to the substance of what's going on in a transaction, not the form. So this is important for digital assets in the standpoint we aren't really worried in the United States about the technology itself. We're just more worried about what's going on. So whether that transaction occurs on paper, on the blockchain, shouldn't matter. It should just be what is happening and what is the economic effect. So for those of you that operate in the industry and you're trying to figure out what does this mean for potential US customers if I'm running a DeFi protocol or if I'm creating a new smart contract, US customers are always going to be looking at what is the economic effect of what's happening. Am I receiving something? Am I holding an asset that's going to be property? And am I going to dispose of it later with some appreciation or possibly loss? And how that's going to implicate their US tax sort of exposure. Now, this economic-based approach has some exceptions to it. Well, that's why I said, the US tax code is sort of ground zero for social engineering. People in the United States legislature love to sit around and sort of horse trade, as we call it, about giving benefits or perks to certain subgroups. And I'm going to talk about that in a little more detail on a couple of slides. And you'll see how digital assets versus what we like to think of as sort of themselves versus digitized assets, which would be assets we all know and understand today, and taking them and putting them on the blockchain, and how that might impact US tax treatment. But the other part of US tax principles is that it's transaction-based. So this is the idea that you have to have dominion and control over something. So this is back to these sort of very basic fundamental economic principles of once I obtain ownership or something, if I have the ability to control it and pass it off to someone else to transfer ownership, that's when it's mine. If I give that up, I've disposed of it, and that's generally a taxable event for US tax purposes. And on the receiving side, it's generally not mine until I've obtained dominion control, the sort of right, the beneficial ownership right to something. And so these are what drive when you talk about things like staking, yield farming. You aren't going to have any income until you actually have control over it. And I'm going to talk a little bit, or actually on our panel later, I hope to talk a little bit more about data problems that exist in the distributed ledger space. So finally, at least under US tax principles, we generally deal with things sort of currency, and I have this up on a different slide, on the next slide I'll get to, but currency and property. So think of property as a very generic bucket that everything fits in. And the reason we do that, I know some countries, we deal with things as sort of what we call capital asset property or trade or business property. Capital asset property is basically all property, and then there's a subset that's trade or business property. That would be property that's used in your trade or business, most commonly things like inventory. And so that gets a particular tax treatment. Everything else gets a different tax treatment, this capital asset tax treatment. And I think in other countries, here we don't sort of separate between speculative assets and investment assets. We just categorize everything as capital assets. To the extent there is some amount of sort of distinction, it is under this notion that when you hold a capital asset property for longer than a year, you generally get a cheaper or a preferential tax rate for it. And that sort of, to me, is very, very analogous to in some countries where we talk about investment-related assets because they often get a preferential tax treatment versus speculative assets. So those are sort of basic sort of survey ground zero or for US tax principles. But now I want to turn, taking that background, let's talk a minute about tax treatment of digital assets in the United States. So right now, as I mentioned, you have sort of this bucket of property. And so the biggest, sort of most salient point in the United States is all digital assets will be taxed as property, not as currency. So this means when you are lending out digital assets, you're going to have a taxable event, where generally currency, if you make a loan of cash in the United States, it's a non-taxable event. So this is a huge distinction, and it's even foreign exchange in the United States is also treated more or less as property, but it has its own specialized treatment. So that's the big part to get if you're there. Now, in the property bucket, there's this idea of general property versus subtypes of property, and this is where I talk about, for me, the way I categorize this is often as digital assets as a thing unto themselves versus digitized assets. And digitized assets being when we're taking tokenizing things, so the tokenized economy, we're taking securities, we're taking, as we just heard about in the prior discussion, collectibles, anything and putting them on the blockchain to tokenize. So those would be using blockchain technology to simply tokenize the ownership mechanism for pre-existing assets. Whereas you have digital assets as a thing unto themselves, so like Bitcoin, Ether, all these sort of nouveau assets that have come into existence. And the reason this is important, I'm gonna see if I'm gonna lose this thing after the thing, is that in the United States tax code, there's all these special treatments for things like securities, commodities, foreign exchange, and real property. Digital assets don't fit in any of those buckets, so they are treated in this bigger bucket of just property. So you're always going to sort of get this generic property treatment, whereas all of these subsets of properties get specialized tax treatment because of rules that exist in the United States tax code. So a lot of questions that always come up when I was working at the IRS would be like, well, isn't this a security or not? And the goal for the IRS would be that the IRS itself is not intended to be the decision maker about whether something's a security under US law. That's a different agency, the Securities and Exchange Commission. Or in the United States, we have the Commodities and Future Trading Commission. They would decide what type of assets fit in their buckets from an agency or regulatory standpoint. Once that decision had been made, if an asset then became a security, then it would just be treated as a security under the tax code. So as you're putting together, if you're a creator out there, or a developer, and you're putting together smart protocols or something, it's important to think about sort of what classification your asset might get in the United States, but then how that's going to impact US taxpayers that might be prospective, customers or using your protocol or whatever, as well as, or even if you're doing planning from a legal standpoint, what impact this might have for US tax purposes if your client's going to be subject to US tax for some reason. So one spot that's a very problem point right now that I think is a very huge problem issue in the United States, but I think it's a problem issue globally, is just merely a definitional problem. And so in the United States, most US regulators right now have traditionally used the terminology virtual currency to describe digital assets. And this goes back almost 10 years now. The United States Financial Crimes Enforcement Network, they handle all of the anti-money laundering, sort of banking law stuff. They were the original agency that came out with a definition directed at digital assets, or what we think of as cryptocurrency, but they use this term, this wonky term, virtual currency, to define this. Subsequently, the IRS adopted that term. Over the years, that term has sort of morphed into day-to-day, most of us in this room would probably just talk about cryptocurrency as our daily use case, or our daily discussion of that type of thing. And then more recently in the United States Congress recently adopted legislation where they use the term digital asset. So you have three terms with about 90% overlap, but slightly different things, and this causes a massive regulatory issue. And so that's the biggest problem right now in the United States, that I think there's no clear framework for identifying. That's where here in Liechtenstein that we have the Blockchain Act that I think helped put up sort of nice guardrails to define how things operate. And that's a huge benefit. In the United States, there's been legislative progress to sort of do proposed legislation that would do the same thing. It would create sort of definitional terms as at least initial point, so everyone knew where they were working from, and all the various regulatory agencies would know where to go from there, like what stuff was called. So that's one of the biggest issues we even have today. It's still a debate that goes on. So when you talk about tax treatment of digital assets, I like to think about it when you go back to this idea of economic principles. So there's only so many things you can do when it comes to digital assets. You can either receive them, so you'll have up here on the left side, you have receipt of digital assets. Well, if you receive a digital asset, there's really only two ways to get it. You can basically acquire that digital asset unilaterally, which would be if I came to your home and I did some work for you, or I mowed your lawn or something, you could pay me with a digital asset. That's sort of a unilateral acquisition. In that sense, for US tax purposes, that's going to be income. It's sort of an element of compensation for doing something. So that's the unilateral side, or the one-legged side of a transaction. The other type of receipt you might get is really what we categorize as a bilateral transaction. And what that means is I've sort of exchanged another piece of property or fiat currency for the digital asset. And in that situation, that's generally not a taxable event, at least the acquisition side isn't. It might be a taxable event if I'm giving up a separate piece of property, on the disposition side. That's a different thing for that piece of property I'm giving up. So those are things to think about. If you're creating a protocol that might have staking or yield farming or something, as you get units, that's going to generally be an income event for US taxpayers. They're gonna have to take that into income at the moment. So the income events, as I said, are payments for services, things like airdrops, yield farming, staking if you're running a validation node on a sort of proof of stake network, you'd get that. Now, on the acquisition side, you can have either fiat, or you have, in the United States, they treat distinct crypto assets or distinct digital assets as distinct pieces of property. So if I give up Bitcoin for Ether, if I were to give up an NFT into Ether or into Bitcoin or something, those would be sort of a taxable trade, but it would be an acquisition of the received side and then a disposition on the other side. So that sort of is the general premise for the receipt of digital assets. Now, when you move to the disposing of digital assets, it's the same concept. You can have both unilateral and bilateral. On a unilateral side would be if I was out here with one of these nice baristas and I was paying them for my cup of coffee, I might pay them in Bitcoin. That's a unilateral receipt. That's going to be a disposition of property that's going to be subject to US tax. And the US tax there is going to be the value of the property at the time I gave it up versus whatever I paid for it or whatever I got it when I acquired it. And so, or if I just sold it, if I traded on a crypto exchange, I might trade my digital asset into fiat. That's a disposal. The bilateral side would be sort of trading in fiat or trading in for another cryptocurrency. So those for US tax purposes are going to be treated as, taxable events. So in generally in the United States, if you're holding property as a capital asset, the tax treatment is going to be what we have as a preferential treatment. It's capital asset tax treatment. This means that if I've held the property for longer than a year, I'm going to get a lower tax rate, as opposed to the United States, we kind of run off what are known as ordinary tax rates and then preferential tax rates. Ordinary tax rates is the same tax rate you would pay for all of your wage income or anything you have. And then with property, if you've held it longer than a year, you get a preferential tax rate. And so you would get, it's a lower or reduced tax rate. It's depending on what your tax bracket you might be in, it becomes less. So this is where I'm back to the point that's a little bit of, I think in other countries, talk about speculative assets versus investment assets. Here, it's just based on holding period, if it's less or more than 12 months. So those are generally, this is kind of, I'm running out of time, but that's generally the the framework for US taxation, but because I know all of you are here and I have a little bit of time left, I wanted to finish up quick enough because I wanted to offer an opportunity for anyone to ask a question, because it's hard to tell what people might want to hear about from US tax treatment because there's a ton of stuff. So I think someone in the back has a question. I think, and a lot of people in the United States think, that Chairman Gensler, who's the chairman of the SEC, of the United States SEC, is a little bit over-aggressive. And by little bit, I mean he's actually really over-aggressive. That's the very polite way of saying it. But yeah, there is actually no reason. This is back to where I think the paradigm we think about is digital assets and digitized assets. So to the extent you have tokenized securities, they clearly should fit under the SEC umbrella. And to the extent, in the United States, from an SEC standpoint, from a securities standpoint that would come under the jurisdiction of the SEC, we have case law, because we're a common law jurisdiction, we have case law known as the Howey test. It's like a multi-factor test that courts would apply to determine whether or not something's a security. And the main part of that is you sort of have to have people putting money in together to do a going concern operation with the idea that other people are going to do the work and you're going to get a return, which would be very much economically fits the definition of if you're a shareholder in a company. There are plenty of cryptocurrencies that don't do that, or digital assets at all. There are a few that could exist, but the sort of very aggressive approach the United States SEC has taken of late is sort of pushing everyone a little bit to the edge that they're getting a little frustrated. And to this point, there is pending legislation in the United States that would actually take most digital assets and put them under the purview of the Commodities and Futures Trading Commission, the idea to treat digital assets largely as commodities, which gets a different treatment, different oversight, with only a subset of them, when they met certain requirements, be treated as securities thing. Oh, so good, my time went up. I was watching the clock, and the time, I got an extra 3 minutes. Can I get another question?
I'm curious, what is your understanding in terms of tokens that behave like utilities or vouchers? Like, for example, Ethereum, when I might pay something with Ethereum, but if I execute a smart contract, I have to pay the gas fees. Right? Like, I pay the gas fees is paying the utility of the network, using Ethereum as a voucher to run, to execute something in the network. Like, is there a specific behavior there? Like a specific
There's a little bit of a mixed treatment for US tax purposes on that. So if I'm holding, if I'm holding Ether as the gas on the Ethereum network, if I need to conduct a transaction that's gonna run a smart contract, so this is gonna be some sort of ERC20 token or 721 or 1155 if it's in the NFT world, and if I need to conduct a transaction, the Ether itself that I hold is going to be treated as property. So when I pay that Ether, when I execute the smart contract, when it comes out, I'm going to be disposing of Ether. So that's going to be a taxable event for US tax purposes with respect to that Ether. And so it'll cost, now separately though, as a separate sort of economic concept, you have the idea that I'm paying the gas fee, I'm paying the Ether as an expense. And that expense, this is sort of gets a little bit in the weeds of US tax, but it's what am I paying the expense for? If we're talking about NFTs, like 721s, 1155s, if I'm a creator, and I need to pay this expense as part of my creator business as an NFT creator, I might have a trader business. So the US tax code allows you to deduct expenses that relate to trader business expenses. So you could have almost two simultaneous, I like to describe it as two simultaneous tax events. On one side, you have the Ether that you're giving up to pay the fee, and so that Ether, because it's property, you're gonna have a disposal. The disposal, you might have taxable income or taxable gain on that disposal, because if the Ether is worth $10, but I acquired it for $5, the differential there of $5 is going to be subject to US tax. Separately though, my $10 expenditure of Ether may be something that is a tax deduction for US tax purposes, because if I'm using it to run a trader business, or if I'm using it just to make a trade, like a swap on a protocol, in the United States, generally your fees or other sort of inherent expenses associated with the transfer of property, so if we're back to this idea that digital assets are property, the fees or commissions, whatever you might pay that are sort of related to the transfer of property, get added to or offset against. So if it'll either get offset against my gain or proceeds that I have, or it might get added to the cost, the acquisition cost that gets used down in the future when I later. So if I were to buy a house today, this is sort of very traditional but a very simple way to explain it, and I have to pay commissions of $10,000, that becomes part of my cost of the house, and later when I sell the house, you'll get the benefit of that, or it's going to offset some of my income for tax purposes. So what's interesting in the crypto space, and everyone in the United States is hoping, some of you probably saw the news, we had MICA, we have just earlier this week, or at the end of last week, we had OECD dropped its CARF, that's its crypto asset reporting framework, which is what's expected to be outside of the United States will be adopted. In the United States, we have similar framework that's coming into play that's going to sort of govern how brokerage-related transactions, so all your crypto platforms that are brokering trades, how fees like that maybe get applied, and how they're going to get assigned on which side of the transaction. All right, I'm down to 25 seconds, so unless someone has any last-minute questions, I'm going to tell you guys, I want to thank you all. I look forward to speaking again in a little more of a multi-jurisdictional panel so we can talk about some more idea sharing among jurisdictions for tax ideas, but hopefully this gave everyone a decent overview of U.S. tax policy and how it relates to digital assets. But thank you all for your time.